When it comes to a 15-year versus a 30-year mortgage, most people pick the wrong one without realizing it. So let's break down how a 30-year mortgage on a $400,000 home costs you over $260,000 more than the 15-year. But first, let's talk about why people choose 30-year mortgages. Most people default to a 30-year mortgage because it's the standard option lenders hand you at first, and because the payment looks smaller and more doable right now. But normal and smart are not the same thing. The monthly payment is only half the math. The other half is what you actually pay for that house by the time it's paid off, and that's the number nobody's talking about. So let's run the real numbers on a real house so you can see exactly what you'd be signing up for. Let's start with a $400,000 house with 20% down. That's a loan of $320,000, the exact same loan amount whether you go 15-year or 30. On a 15-year fixed-rate mortgage, you're at 6% interest, and your payment lands at about $2,700 a month. On a 30-year fixed, the rate is a little higher at 6.75%, but the payment drops to a little over $2,000 a month, $624 less every single month. So right there, people stop doing the math. Lower payment, easiest decision, done. But that $624 isn't free. You're trading it for something, and that something is 15 extra years of debt on your house at a higher interest rate. This is the part that actually matters. Here's what that $624 a month difference really costs you over the life of the loan. On the 15-year, you pay just over $486,000 for that house, principal and interest combined. But on the 30-year, you pay over $747,000 for the exact same house for the exact same $320,000 loan. That's over $261,000 more on the 30-year, about 55% more just to shave a few $100s off your monthly payment. So it's simple math. You stretch the same debt over twice as many years, so interest had twice as long to pile up at a higher rate. On top of the extra cost, the 15-year gets you completely out of house debt in half the time, and it builds equity faster because more of every payment goes toward the loan itself, the principal, instead of the bank's interest. So yes, the 15-year payment is bigger. That's one real trade-off here, and we're not going to pretend it isn't. But that bigger payment is what forces the house to actually get paid off. It's built-in accountability. There's no 25th year where you're still writing a check for a house you bought before your kids were born. And once that house is paid off in 15 years instead of 30, that entire payment, $2,700 a month, becomes money you get to build wealth with instead of money the bank collects. So what do you do if the 15-year payment doesn't fit your budget? Maybe that $2,700 a month is a stretch for your income right now, and that's a fair problem you're going to run into. Here's the rule to check yourself against. Your 15-year payment should land at 25% or less of your after-tax monthly income. If it doesn't fit, the fix is not to switch to a 30-year to shrink the payment on paper. That doesn't solve the problem. It just hides it for 30 years and tax 6 figures of interest on top of it. The fix happens before you ever buy the house, not after. Save up a bigger down payment, shop for a less expensive house until that 15-year payment actually fits your budget. And that 15-year mortgage is the only one that Dave Ramsey recommends. 15-year fixed-rate mortgage with a payment at 25% or less of your take-home pay. That's the whole rule. It's not complicated, and it's not negotiable just because a lender's offer looks lower on paper. And if you can do even better than that, do it. If you can pay cash for a house with 100% down, that beats a 15-year mortgage. And the 15-year mortgage beats a 30-year every time. So when it comes to a 15-year versus a 30-year mortgage, the wrong pick is the one that looks affordable today and quietly locks you into decades of extra debt tomorrow and the next day. A house is probably the biggest purchase you'll ever make. So run the numbers before you ever sign anything, stick to the rule we just gave you, and buy a house you can actually own outright one day. We want you to own the home. We don't want your home to own you. That's the goal.